Hello and thank you for choosing to watch this video. Now, there are a lot of different ways that people value companies out there, and I think that the market as it is at the moment is it's really confusing a lot of people because they don't really understand why prices are the way they are. And they also get a lot of people out there that claim that a stock is either overvalued or undervalued, and I just don't actually believe that that's true. Pretty much ever now in the way that the market is. So this video is for me to explain how I personally value a company, and how I believe that the market as a whole is reaching its price, based on that. And so the way that I value a company is, in many ways, it's quite unorthodox in the regard of if you pick up any book on how to value a company, or if you watch any video on YouTube on how to value a company, you will get a lot of mathematical calculations that will give you a number at the end of it. And in my opinion, that number that you come out with will either be a out of date number that is now completely irrelevant, unless of course you have a business in a complete vacuum that is not actually planning on doing anything different for the next 10-15 years, and is not expecting to have any different results over the next 10 to 15 years. Either that, or you will be having a very specific number based on guesstimates of, I think that the business might make this many sales, and therefore I'm going to guesstimate that this number is the amount of profit that they'll make. So again, completely pointless of that actual physical number. So because of the fact that I can't actually give you a physical number for the stock, I think a lot of people will look at the way I value a business and they'll go, he's an idiot. Why? How can you possibly do this? And I guess really to an extent I don't have a comeback to that really. So let me walk you through it, and hopefully by the end of it you'll understand where I'm coming from, and understand why this seems to be working for me so far. Anyway, so now don't get me wrong. Well, even though I don't come up with a physical number, I still spend a lot of time looking through the company's financials. I still check out things like their debts, their profit margins. I still go through the company's full financial report. There is not a single company that I currently invest in that I have not been through their financial report and their annual reports, because to me that document is the most important document that the company produces. But for me, calculating a company's physical value is it's just redundant. So now I do need to stress that this particular way of calculating as such a business, it applies to the market as it is at the moment. This could change in the next 6 years or 6 months. Something could change in the market that would actually make this way of calculating the value completely redundant, and you might need a whole new skill, a whole new way of doing it. Having said that, this could be the same way to value a company in 60 years' time. So it's all about understanding the market, understanding where it's moving, and adjusting yourself as the market progresses. And a big part of the reason why this works is because of the fact that you still have the people that do those old school fundamental calculations. Because if you've not got someone out there that's doing the calculations of, this company has £1 billion worth of assets and £500 million worth of debts, so physically they have £500 million worth of value purely from nuts and bolts. So if the company went below that value, you know that actually you could buy the company and then break it up for parts. Now, if people are doing those calculations, then that means that you know that the company's never going to go below that value, because the people that are doing those calculations won't let the price get that low, because they'll be buying the stock thinking they're getting a bargain and pushing the price up. So that's how you that's why you don't need to do that kind of calculation, is because there's people out there doing it. And if those people suddenly disappeared, then my way that I'm talking about now would just not work. So that's why it's important to keep an eye on the market as it's moving, and to analyse the market as a whole in that regard. So the first point I need to make is what I actually call the market. So the market is the collection of all the people who own or want to buy or sell a stock. When the market sets a price, it is the average of all of these people together. And that the market price is based on the lowest available price. So if the market is open at any one point, the market price is obviously, that's the lowest that anyone is willing to sell a stock for at any one time. That's how that market price is actually kind of made, and obviously you should know that anyway. But what makes that market price move is obviously the valuation of the company, because as soon as, if the average person out there felt that the average person in the market felt that the stock value was, say, 150, and the price drops to 140, they are instantly going to start buying those stocks and pushing it up to 140. Now, if you've got people out there that think the stock value is worth less than 140, if they own the stock, they're going to be selling it. And that is what pushes the market price to the average of what everyone as a collective believes that stock is worth. So that collective price is what, for me, that's the market price. That's what the market is saying that stock is worth. And that is why, in my opinion, a stock is never overvalued or undervalued, because the market will always keep the stock at the price that it should be in that regard. So I hope that kind of makes sense. Anyway, so why I don't calculate a company's actual physical value. Now, first of all, ask yourself, how do you value an everyday product? If you go into a supermarket and you wanted to buy a pen, for example, do you walk over to the pen aisle, pick up the pen, and then pull out your phone and start calculating the physical price of this product, all the materials that have gone into it, all of the tax and everything like that? No, of course you don't. You make various assumptions based on information that you already know. You already know roughly how much the pen's worth, because you know how much other pens would cost you. So the same would apply to a company. You know, if you know other companies that have a similar product margin, have a similar product outlook, you know, then they're heading in the same direction, they're looking at the same kind of market, they're looking at the same growth, you can kind of get a bit of an understanding of where that company's heading, and why, whether that company has a roughly average price comparative in that way. And the other thing with your pen is, the reason that you know that you're paying a fair price is because of the fact that you know that the supermarket is not going to have a huge overly priced pen that one of their next door neighbour shops is also selling, but for a lower price, because they know that that would make you go into the other shop and buy it instead, and that keeps the price at a fair price. And to an extent, that's the same with the stock market. If because there's so many people in the market that are buying and selling a stock, that's why it stops that price going over or under. Because if it goes under the actual value of the average market, the market pushes it back up again. If it goes over, the market pushes it back down again. And that's how you know that whenever you buy a stock at its market price, you are actually getting it for a fair price. It's not overvalued, it's not undervalued. It is what the market believes it is worth at this particular time. So there's that part out of the way. So so fair value. Fair value is the value of a stock based on its history with an expected future impact. So what does that actually mean in numbers? So if you imagine a perfectly stagnant company, each year it has exactly the same returns. It's in some kind of like world bubble where everything stays the same, and you're not expecting the company to make any extra profit next year or any less profit. Nothing's going to change, and the demand's going to stay exactly the same. So in this world, the price of that stock is going to stay completely stagnant the whole time, because there's no other elements changing. So, for example, with this, let's just say the stock is worth $100 a share. Now, imagine that company gets a new management team and they make a new announcement that they're planning to release some new amazing product. Now, instantly, the market will look at that new announcement and they will make a million calculations. How much is it going to increase the value of the company? What changes will it make? How likely is it that this product's even going to be made? Or that it's going to be made and it's going to have the functionality or make the impact that the company is saying that it will. Now, the market is looking at this product, and obviously in the real world, it will calculate a million different possibilities. But to make this simple, we're going to count two possibilities. Okay, so it's either the product launches and it's a complete success, and on that basis, the company's stock will be worth $150. Or the product fails, the company goes back to exactly how it was, and it continues to just chug along as it was. And in which case, obviously, it remains at $100 a share. Now, as soon as this announcement, obviously, as with all announcements, it happens when the market's closed. So the market opens, and instantly the price of the share has jumped up to $125 per share. And the reason for that is because the market has assumed that there is a 50% chance of failure. So there's 50% chance that the product's going to work, and the product's going to the share price is going to be $150, and there's a 50% chance it's going to fail, and it's only going to be worth $100. So that's how that kind of price gets reached. Now, obviously, again, in a real world, it wouldn't be $125, because even with that 50% chance, you would have a lot of various different risk elements that people would calculate in. But again, like I say, this is just for the simplicity of trying to explain this. So then, once you've got your price of 125, the market opens 125, and you're going to get a lot of the traditional analysts that are going to say, but hang on a minute, the company's financials haven't changed. I'm doing all of their financial details and they're still worth $100 a share. They've got no new sales, so why any extra money that I'm paying for this stock is overvalue, and therefore this 125 price, it's overvalue and it's only worth 100. Which obviously you can understand where they're coming from, but that's how they've got that price, and that's why you've got these people coming out saying that the company's only worth $100. You've then got what I would call the modern analysts, and they're the ones that are saying, there's a 50% chance that this is going to be worth $150. And again, this is the average of these various different analysts, because you'll have some that will be saying, oh, if it fails, it'll damage the company and it'll only be worth $90, and all the various different things. But that's, again, real world situations and how that would impact it. So then going forward, the price, that 125, is going to go up and it's going to go down. And the reason that it's going to go up or it's going to go down is it's based on the people that are in the market that think this new product's coming out, and they're analysing the price of this, and they're the ones that are kind of looking at the situation, and they're getting the news from the company, and they're going, this product, it looks really exciting, so we're going to push the price up because it's more likely to happen and it's more likely to be a success. And then something else might happen, and maybe a competitor's product may be announced as well, and then you'll get a whole downward trend of people kind of going, oh, I'm not so sure it's going to happen. And then you'll get new people entering the market that will push the average price up, or then you get some people that will leave that may push the price down, and vice versa. Again, it's all causes the price to fluctuate, and that's why it's moving in those various different directions. So then we come to me and the way that I value the stock. Now, I don't by any stretch of the imagination think that I am the only person who does this. And when I look at the market, I think actually most people actually do this. But I don't think many people actually say it in this regard, because I think everyone's looking for that number. Any investor who is looking to an analyst, they're saying, well, I need a number. I need a target of where I'm going for. So I think that kind of fluffy nature of the valuations that I do is what causes that that issue of why you end up with all these numbers floating around on what a stock's actually worth. So going back to our $100 business, so what I do is I look at the product, and I look at the way it's being released. I look at further forward than this one product, and I look at the management team. I look at the business as a whole. I look at the direction that it's going. And I look at this $100 business, and I see the new management team that is shaking things up. I see this new product as the first in a string of new products that are going to transform the future of this company. I see them talking about expanding into international and new markets, while also having the ability and the knowledge to do so. And that, again, is another very important thing, is you need to have confidence in the management team that they're going to be able to actually achieve these goals. Because if you can have the best ideas in the world, but if the management team is not going to be able to pull these ideas off, then it's kind of pointless. So that's, again, you can get these big valuations of where a company's looking all exciting that they're kind of going to get to this level, and then you realise that the company director is not actually able to do what they've said they're going to do. And then obviously that's when the price of the company drops, is when that ball drops, really, like, when it becomes obvious that it's just not going to happen. So, so when you've got the confidence in the company, so obviously this example, I've got the confidence in that company and that they're going to achieve this, all these goals that they've set out, then I know that it's safe to invest at $125, because even though it's technically overvalued by 25%, the immediate upside is that stock should climb to $150, because I'm confident that not only is that next product going to come out and be a success, but after that, more products are going to start coming out. And not only that, but I think the $150 target is going to be reached earlier than when the market is, as an average, is confident of the success of this product. Because what's going to happen is, as the share price climbs up and the management team release more information and increase the market confidence in their abilities, and it becomes more obvious that the business is going to expand, a lot more of the speculation starts to come into the share price. And that's why that 150 price that you would be expecting when a new product is released suddenly gets surpassed way before that product's released, because of the fact that now we've overshot that product. We're now looking 5, 6, 7 products down the line, and that's what you need to be doing. Because if you're not anticipating all those different products, or even on the flip side, if you're kind of seeing a business that actually they're in a decline, or they're kind of stagnant, but there's this new disruptor thing coming out and they're not keeping up. So actually, although they're doing okay at the moment, in 3-4 years time, they're suddenly going to hit a wall and their sales are going to drop. And if people see that, even though maybe their sales might be climbing and their profits might be climbing, it's very likely that their share price could start dropping. And again, people will look at the financials and they'll see a company getting bigger and making more money, and they'll see the share price dropping and they'll go, oh, it's undervalued, it's a bargain, let's jump in. But there's a reason for it, and that reason is because people are looking at that company and they're saying they're not keeping up. So just because the financials of a company don't add up to its share price, it doesn't mean that the price is wrong. There's so many more elements to it. Okay. Now, all of this is quite a simplified, basic version of how I value a company. I say simplified and basic. I've probably gone around the hedges so far that I've probably confused most of you. So if that is the case, I'm sorry. But if you have understood what I've said, and you're like, yeah, that's fine, but that's really basic, I need more, then make sure to comment below and let me know. Because if I can explain things better, if there's more of a focus on something else that you want me to explain a bit better, then make sure you comment and I can try and address it, either by commenting on your comment or by making a new video. So there we go. I will also be releasing stock analysis videos in the future, which should help you to understand a lot more about how I do this. But you can also check out my website, which is wesinvestments.co.uk. The link is in the description below, and you can see write-ups on the stocks there, so that should help. Please do not underestimate exactly what I'm saying here, because in many ways what I'm saying is the trading version of licking your finger and holding up in the air to see which way the wind's blowing. It is impossible to really estimate what future sales are going to be. Ask anyone who has written a business plan, okay? Because when you estimate the sales that they're literally a complete guess. I challenge anyone that's watching this video right now to show me a business plan with projections from before a product sale started that actually proved to be accurate, because I've never seen one. But that does not mean that you should not fully understand the business that you're investing in. I spend hours researching a company, and also staying up to date daily with news on the companies that I invest in, because to me it's so important to be able to stay on top of that news. You know, if you start to get the inkling that actually the CEO is not up to the task and actually they've overshot, then you know that you need to be getting out pretty fast. Because as soon as that happens, all of that future projected earnings is suddenly going to melt away. So that's why you need to be very on top of every stock. And it's why I personally only invest in a handful of stocks, because some bad news can come out, and that if it's a big thing, it will drop the price dramatically. But often there are warning signs before that big news. And if you are a avid watcher of that company, you will see those warning signs. So, or at least I hope you will. But as an idea on the level of kind of detail that I go down into, I have just written a 17-page analysis on Disney, and I've just added that to the website. So by all means, have a check that out. Maybe most of it is all waffle, but you know, like I say, this is the kind of thing that I spend a lot of time making sure that I know as much as I can about the business. So that ends this video. I hope that it's helped you, and if it has, please make sure to like the video and subscribe to the channel. I will only create the content on here if people actually want to see it and people actually want to hear it. So if you don't like it, that's fine, it doesn't matter. But if you do and you want to see more, then I need your support. Okay, so if you do want to see more, please make sure you like, you subscribe, comment below, and tell other people about it, because it's the only way that this channel will grow, and it's the only way that I will make more content. So thanks for your support.